Hello and welcome to another video on my YouTube channel. My name is Joris and today in a very short video I will explain why I don't invest in bonds and why I'm certainly not going to invest in bond ETFs. So first off, what is a bond? And I'm just going to keep it really simple. So a bond is a fixed income instrument, an investment product where individuals lend money to a government or company at a certain interest rate for a certain amount of time. And in this way, a fixed income instrument is the most important thing for a lot of people to invest into bonds because they believe it's a really good product to diversify their portfolio to guarantee them a more fixed income. And in that regard, I totally agree with them. I can't disagree. But on the other hand, I'm going to explain in this video why I'm not investing in the bonds. And another thing, of course, is that bond prices fluctuate in price during their existence, and this in relation to the interest rates of the central banks. So when the federal interest rate goes up, your bond will go down in price and vice versa. So when the interest rate goes down, your bond will go up in price. But in the end, it actually doesn't matter because when you buy a bond, normally you will keep it till the end of its lifetime, and at the end of the lifetime you receive the initial amount also back into your account. So I have an example from Elia in Belgium. They had an emission in June of 600 million euros that they needed to do extra investments, and they gave out a bond of 1000 euros. I don't know whether or not it was exactly 1000 euros, but it's a good amount to calculate things with. And on every bond, you receive every year 3.875% of interest rate. And this for the next 7 years. So the expiry date will be at the 11th of June in 2031. And the settlement date was also the 11th of June in 2024. And this is on the Euro MTF market, so that's a really important market in Europe. And it's the multilateral trading facility regulated by the Luxembourg Stock Exchange. And in that way, every year on the 11th of June, people that own this bond will receive 38.75 euros. And on the expiry date, they will receive 1038.75 euros. But always remember, in Belgium, you have a withholding tax of 30% on the interest rate that is being paid out. So you have to keep that in mind to have your netto interest rate. So this is brutto, and when you want to know the netto amount, you have to always deduct the withholding tax. But you like Elia. So you believe that they will be able to pay you your original 1000 euros back in 2031 and also pay you every year the coupon interest of 3.875%. So you don't have to worry about the price fluctuation of your bond because you are going to keep it till it expires. But do you buy the bond then, or do you buy the stock of the company? Because you believe in Elia, so I say then I buy the stock because I believe that the company is going to outperform the 3.875% that they promise on their bond. And then I believe it's better to buy the stock that can go up in price as well, besides also giving you a nice dividend. Elia is a good dividend payer as well. So in that regard, I think it's always better if you like a company that emits a bond to also look at the stock, and if it's priced well, buy the stock and don't bother about the bond. So you can say, yeah, but government bonds are different. And are they really? I don't think so. Because, okay, most of the European countries have a better credit rating than most of the firms that you can buy bonds from. Yeah, some companies have, of course, really high credit ratings, but most of the time the countries themselves are more reliable than the companies. So you are taking less risks when you buy a government bond. And they don't have a stock that can go up or down in price. And for some people, this is a positive point because they are afraid of losing money. But in my opinion, if you believe in a company because you think they will earn enough money to pay you back, and on top of that, pay back your interest rate as well, then why shouldn't you invest into the company itself? So, in the long run, as well, government bonds never have beaten the stock market returns, as it is the market that makes the government great. And the market, I mean by that, it's the people and the companies. Governments, of course, they can change the regulations and they can hamper with the possibility of the market to make a government great. So in China, for example, the government, yeah, they really have control of the companies, and now they are stimulating the economy big time again. And actually, they should have done it earlier, but yeah, they control the market, but actually it's always the other way around. The market makes the government great. So it's normal that the government bonds can't beat the stock market returns. So what I do, I buy stocks or index ETFs. But why do you don't invest into bond ETFs? Because if you invest in a bond ETF, you are not the only one deciding, not the only deciding factor whether or not the ETF has to sell the bonds that it holds. So you have a bunch of other people that own the bond ETF as well, and they can panic for the slightest thing that happens in the world and decide to sell their ETFs. So there is something that is going on in the world. They see that the fictional price of the ETF goes down because the interest rate of the Fed goes up, for example, with 0.25. So the fictional price of the ETFs, of the bonds that the ETF holds, are going down. But normally it shouldn't matter because at expiry date, everything is going to be paid out because the bonds that they hold are from reliable companies or reliable governments. But they panic, they sell, and then the fund manager needs to provide the cash to the market maker because the market maker needs to pay to the bank so the bank can pay the one that sold the ETF. So he needs to sell the bonds that are now lower priced fictionally because yeah, the price lowered, but they still have the actual value of 1,000 euros, for example. But yeah, it is sold. So the fund actually takes a loss on the bond and the actual price of the ETF goes down. So in fact, when nobody sells, at the end of the expiry date, everything is fine, everybody gets their money, but as stupid people sell, your ETF goes down, you can't do anything about it, you just see that it goes down, so it's frustrating. So that's why I don't invest in bond ETFs. So no bond funds for me, not mutual funds, not exchange traded funds. I like being in control myself. But stocks are also influenced by others, that's true. But those moments when it goes down because other people are panicking, then those moments are buying opportunities for me. And also remember, as long as you buy index ETFs or quality stocks, you are golden for the long term. So with that being said, I thank you for watching this video. Hit that subscribe button if you like this kind of content. Hit that like button as well. It helps out spreading this content to other people that like this kind of content. And see you on the next video on my YouTube channel. Bye.